Well, good afternoon, everyone. Welcome to today's midday webinar on Monday, the 18th of March. And we are at the beginning of another week of trading, a busy week of trading, and a number of central banks out over the course of this week, which we will have a look at over the course of this webinar and obviously in more detail as we head towards later on in the week. Now, not the expected reaction to a start this week. If you had have asked me on Friday, there's a couple of things out over the weekend that have helped to boost stocks higher. I'm not so sure I'd really believe this article. Nasdaq S&P 500 futures trade higher in lead up to Fed meeting. I think that headline is maybe a little bit misleading. Tesla's is a Model X, Model Y, I don't know what model, but some model of their cars, they've hiked prices in throughout Europe, so that is obviously a positive for the Tesla stock. And news out over the weekend that Apple are planning on bringing Google's Gemini AI into their iPhones. So Google, or their parent company Alphabet, up a pretty substantial amount off the back of that, obviously due to the fact that if Apple are going to include their AI in all of their Apple products, obviously it's a massive boost for the company. So shares in two of the major companies across the Nasdaq up higher to start the week, which is obviously positive then for the Nasdaq and then the broader equity space alongside that. Dollar dips, yen steady as BOJ policy shift beckons. Now it's a pretty difficult one when it comes to the Bank of Japan. I think we'll have a look at a bit of the Bank of Japan once we get around to the economic calendar. But you've also got the Bank of England out this week, the Swiss National Bank as well, although that will take a back seat when you think about you've got the Fed, the Bank of England, and the Bank of Japan all out over the course of this week. But stock index is not up off the back of the lead up to the Fed. They're up off the back of price hikes in Tesla, and then Google's AI being involved with Apple products. Then going forward, when that starts, I'm not actually too sure, to be honest with you, but obviously that is a positive for the price of stock index, and you can see the Nasdaq up already over a percent before the US Open. Right, that drags kind of the broader equity space with it. The S&P up 0.7%, Russell up 0.5%. The Dow Jones not really doing too much. Apart from that, the European stock index are pretty flat, but still more positive than flat. Asia Pacific equities more positive than flat as well. A couple that are down are only down a slight amount. The broader base Chinese index up 1%. Asia Pacific index is up nearly 1%. Australian index up 0.1. But commodities up across the board, pretty much in line with equities, in line with the recent trend in oil. But bond yields lower, which gives a bit of a support to equities. But an easy way of being able to tell for yourself whether this is a move in the lead up to the Fed on Wednesday is, are all the US assets moving in the same direction as what would come from a dovish reaction? Equity markets up across the board. That would lead you to believe a dovish reaction to Wednesday's meeting. You get bond yields, which are lower, but not lower by any sort of massive amount, and then longer dated bond yields are higher. Global bond yields are mixed, and also the US dollar is mixed and pretty much unchanged against a lot of the other major currency pairs. So you would see broad-based dollar weakness. You'd see the US dollar down across the board if stocks were up due to the Fed meeting, which it is not. They are just being held up by some positivity from Tesla and then Google, which is not actually Google, it's Alphabet, right? That then brings your Aussie and your Kiwi up with it, not exactly up by much percentages. None of these FX are moving by much percentages, so not a lot of action across FX to start the week. Stock indexes are up, bond yields relatively mixed. So that, again, that just tells you the equity futures are up off the back of those couple of bits of news from the weekend, right? You can have a look at the US dollar, and the US dollar you can see is relatively mixed. Euro dollar kind of grinding higher, but apart from that, you're not really seeing too much anywhere. I mean, gold is pushing higher a little bit, which is a bit annoying. That move lower into the close on Friday and then to begin the evening was kind of what we were hoping for last week, and is exactly what I'm still hoping for, is gold to be lower over the course of this week. I do still think it's a pretty good trade, regardless of it being positive over the course of the first few hours of real trading this week as we get into the European session. But you can see FX across the board not really doing too much. Equity markets up across the S&P, the Dow Jones, the Nasdaq, the Russell. Dow Jones only up slightly, but you can see the Nasdaq and the S&P enjoying themselves certainly over the last couple of hours, but certainly over the course of today as well. Monday morning in the overnight session, both of them rallied, and that has now dragged the other two with it in recent trade. Bond yields relatively mixed, as you can see. Sorry, what am I off to here? You can see the 10-year, right, the 2-year Japanese bond yields a bit all over the place, but USO2Y, right, USO2Y bond yields in the US relatively mixed. Now, these would be pushing lower if markets were expecting a dovish reaction on Wednesday. Not quite what I'm expecting personally, but we'll cross that bridge when it comes to it a little bit on Wednesday. Oil, bit choppy, up overnight, down over the last couple of hours, so not much to see there. And really, you can see just by doing this analysis across the board, the only things that are really moving are equity markets. And again, that is not driven by anticipation for Wednesday. That is driven by the reaction to the different bits of news out over the weekend. Economic calendar then extremely busy over the course of this week. All right, you've got a raft of different things. This is sorry, I'll just go this week. Let me see. This is all of this week. You got loads and loads of different data releases, high impact and medium impact. But if I just go to the high impact ones, you can see the RBA. So I think I have Japan on this calendar, do I? Nope. Save that. We can see the BOJ as well. So you got the BOJ, you got the RBA, you got the Fed, you got the Bank of England, you've also got the S&B. So you got 5 of the major central banks out over the course of this week. Now, in terms of all the major central banks, we'll go through them kind of one by one, and we'll have a look at potentially what to expect. Now, the Bank of Japan and the Fed are, in my opinion, probably the ones you need to keep an eye on the most. Bank of Japan might be a pretty difficult trade overnight. RBA, Bank of England, kind of a little bit more difficult to predict. I think personally the S&P, I'm not going to speak too much about the S&P, is not sort of the main focus of markets' attention over the course of this week. But you can't make too much of a decision on the Bank of England just yet, because you do have CPI on Wednesday out of the UK. But if we start with the Bank of Japan, the Bank of Japan is tonight or tomorrow morning at 3 o'clock. Now, they never come out bang on 3 o'clock. They kind of give or take 3 o'clock, give or take. They might come out half an hour before, half an hour after. Depends when they decide to get up out of bed. But the Bank of Japan, you can see consensus is to 0%. Minus 0.1% is the current interest rate in Japan, and markets are expecting the end of negative interest rates from the Bank of Japan, and also the end to their yield curve control. Now, the question is, does that result in much Japanese yen strength, right? On face value, it should, right? But that's kind of expected by markets, right? And it hasn't managed to really sustain much Japanese yen strength. And when I have a look at dollar yen continues to trend higher. A big downside last week, but not last week, the week before, sorry. But that was a US dollar move. That was not a Japanese yen move. That was a US dollar move, right? And it's been trending higher ever since then, right? Which is then downside in the Japanese yen, right? Which is, you would expect, if they're going to end their negative interest rates, right? They're going to end their negative interest rates and they're going to remove yield curve control. That is a hawkish step, right? Negative interest rates mean that they pay you interest to take out a loan. That encourages people to take out loans and then go spend that throughout the economy. Yield curve control is a bond purchasing program where they purchase bonds in order to push yields down to keep the 10-year yield was at 0% or 0.25%, and they raised it to 0.5% and raised it to 1%, and then had a kind of rough band of 1 or a rough upper band of 1, not an exact science of whether they keep it exactly 1. They might be happy with it a little bit above, but they're going to remove that completely, or they're expected to remove that completely in tonight's or tomorrow morning's session. Now, you would think the reason why they keep yields suppressed and try to keep yields lower is because a lot of things are based off around the 10-year yield. You know, you get finance on, let's say you get mortgages, right? You take out a mortgage payment. You know, mortgage payments will be based loosely off the 10-year yield. You get finance on a car, you take out a loan for your business. A lot of the interest rates will be a lot of interest rates or things that you pay interest on throughout the economy are kind of based loosely around the loosely around the 10-year yield. Not exact science, but based loosely around the 10-year yield. So if they keep 10-year yields low by purchasing bonds, that keeps interest rates throughout the broader economy low without them actually having to adjust the interest rate. Right, so it's kind of a guide, not an exact science. It's a bit of a guide. The actual interest rates, set other things for it, kind of bank deposits and stuff. But then if they remove that and they go and move away from negative interest rates, right, that is a positive step. They've gone to zero. They've gone from paying people to take out loans to then just it being flat, which is still free money at the end of the day, right? You don't have to pay any interest on the money, right? So it's a hawkish step, but it's not that hawkish. Do you know what I mean? You got interest rates in the US at 5.5%. In Japan, you're just not getting any either way, right? So that's one thing to keep in mind on. That's easy to sit there and be like, the hiking interest rates, that's hawkish, but is it really that hawkish when you think about it? They're also removing yield curve control, so they're allowing longer dated yields to rise a bit and then allow the markets to decide what the correct interest rate is, right? But if you have a look at the US yields, right, you have a look at the US 10-year yield, that at the moment is at 4.3%. If you look at the Japanese 10-year yield, that is down at 0.75%. Right, so there is over 3.5% difference in the two interest rates, right? The Japanese 10-year yield has a lot of ground to make up in relation to the US. The reason why I'm looking at the US is because a lot of Japan's debt to GDP ratio is the highest in the world because of this negative interest rate cycle, right? And a lot of their debt is denominated in US dollars. So if the difference between their own interest rates and then US interest rates is large, then that's obviously not a good thing for their economy. If that continues to stay the same distance, that's again not good for their own economy and just makes the Japanese yen less attractive towards the rest of the other currencies. You'd rather hold other currencies, so not good for foreign investors either, right? So the markets are expecting them to end negative interest rates. The markets are expecting them to remove yield curve control, right? That is completely expected, and that is what we're expecting to come out from the meeting, right? What markets are unsure about is their path after doing this, right? So the actual decision itself is not going to be what moves markets. The reaction or their accompanying statement is what's going to cause a reaction in markets, right? If they come out and they say that we're going to continue to hike interest rates are going to go wherever they go, but they're going to continue to hike, well, then that will be hawkish and the Japanese yen should strengthen. But if they say they're just exited negative interest rates, and they turn around and say, we're not gonna do anything past that, right? They're not gonna continue to hike interest rates. They're just gonna leave it like that for a year or two and see where they end up. It's probably a situation where the Japanese yen weakens, right? So be a little bit careful with the Bank of Japan overnight. We cannot make much of an assumption into it until we get their statement. Once we get their statement, we don't have to jump on the actual move at 3 o'clock in the morning. We can reevaluate it tomorrow, and that move, whatever comes from it, should be longer lasting. Whether they backtrack on future hikes or whether they confirm future hikes, they will need to do one or the other, or probably should do one or the other. That then gives us an indication as to what direction you can trade the Japanese yen in past that. Right, you get the RBA then, right? The RBA have stayed firm for a couple of meetings. They did have one hike a few months back, and then have stayed firm at their 4.35% interest rate, right? And yet again, you'll have to look at rhetoric around that. Do they go and clarify that they are finished hiking interest rates? That's probably what you will need to look at. You need to look at then inflation prints from Australia. Prices. We can go inflation rate. Inflation rate year over year, still at 4%. You can see that is coming down, right? Q3 down to 4.1%, right? Previous one 4.1%. The next one is on the 24th of April, so they're not likely to suggest that they're done hiking interest rates just yet, but they will note this downtrend in inflation. Inflation continues to ease. They will probably give some sort of forecast for their next for the next inflation print, and there's probably more of a chance of them coming in more dovish, being in line with this downtrend. They'll expect it down towards 3%, at the next meeting, that is more like what they want in order to get inflation under control. So the RBA probably more chance of being dovish, I would say, than hawkish, due to the fact that inflation continues to trend lower. Trading economics forecast of 3.4. We don't have a consensus just yet for the next inflation print, but likely to be somewhere around 3.4. As you can see, the previous two forecasts pretty in line with market consensus when they do come out. So again, we'll kind of cross that bridge when it comes to it a little bit. So they're likely to say they still need to wait and see this data print come out, but we are near the end of March. They will be able to make a fair assumption, right? And they're probably likely to reiterate the fact that they're near the end of their hiking cycle, if not done their hiking cycle. So I wouldn't expect too much out of the RBA, right? I certainly wouldn't expect any hawkishness. Any hawkishness would be a surprise to me personally. Then comes into the Fed, right? We got the Fed on Wednesday. Now, economic data continues to be positive from the US. You had a week or two where it wasn't great, but then you look back to the previous week, right, where you've got consumer price index beating consensus across the board, apart from the 1 month over month print. 0.4 and 0.4 for the total rate and the core rate of inflation month over month in the month of February is not exactly cutting interest rate territory, right? You then look at PPI, producer price index, from the month of February. That is 0.6%. That is a big beat on consensus and a big beat on previous. 0.6 plus 0.3 is 0.9, right? Obviously, you can do that maths for yourself. But then 0.6 increase on the 0.3 increase from the previous month, it's kind of like nearly a full percent in terms of inflation for the producer over the months of January and February. And you would kind of expect January and February to be kind of a little bit negative months, due to the fact that you're just out of Christmas. Everybody spends a lot of money over Christmas. You know, people make their salaries last for 6 weeks in January. Again, economic data was good in January, right? Again, into February, economic data not too bad in February. Producer price index high, consumer price index high, as not a situation where they go and cut interest rates, right, or need to cut interest rates. So it probably brings us on to then the Fed into these economic projections. Now, the markets, they did communicate back end of last year, they're expecting 3 interest rate cuts over the course of this year. We're at the end of March, right? Then they won't have a meeting for another 5 or 6 weeks, right? There's certainly no need to cut interest rates now. Probably not going to be a need to cut interest rates at the next meeting. Are they going to cut three times in the second half of this year? I don't know, to be honest. I don't really know, to be honest. Like, they want inflation to get down more, right? So I think it'd probably be worth them at least talking a bit hawkish at their meeting on Wednesday, right? Do they remove one of those cuts from one of the projections? That won't cause a massacre across markets, but it will cause a bit of downside across markets, and also probably cause people to spend a little bit less money, I would probably imagine. So I'd probably go more on the side of I'd probably go more on the side of the hawkishness, shall I say, due to the fact that they still have work to do clearly to get inflation down. And it's not a situation where they need to hike interest rates. What do you do in that situation? I think you have to at least talk a good game if you are the Fed. All right, that brings us on to then the Bank of England on Thursday. All right, with the Bank of England, some market participants, or a lot of market participants, think we won't get the first interest rate cut in the UK until August. Right, now that is a little bit behind a lot of the rest of the major central banks, so that's one thing to keep in mind. Right, they're not going to hike interest rates again. Let's go down to the medium impact data release, and we'll just see where the vote split lies in terms of consensus. Right, you got the Bank of England then, 1's voting for a cut, 2 to vote for a hike, 6 to vote for it to be unchanged. You obviously get a bit of a difference. Some people are naturally more hawkish, some people are naturally more dovish, and then the majority of them kind of sit in the middle, right? So we'll have to keep an eye on that. Expected no change from the previous month, but do they take a step more towards interest rate cuts, or do more of them expect interest rate cuts, or, you know, does the one that votes for a cut go back to unchanged? Again, we'll have to see. But I don't think we can really make much of an assumption on the Bank of England until we get inflation figures out of the UK on Wednesday morning, right? We're expected at 3.6% for the headline year over year. For the core year over year, we're expected 4.6 versus 5.1. On the inflation rate month over month, I know 0.7% is what's consensus, but it was minus 0.6% in January, which is to be expected in the month of January. And then a bit of a bounce back in February is not too out of the realms of possibilities. But yeah, as I said, I don't think we can really make much of a decision on the Bank of England until we get those inflation prints. I mean, you can go one way or the other. You can say if inflation comes in high, well, then they're probably likely to talk a bit more hawkish. If inflation comes in low, probably likely to talk a bit more dovish. And I guess we kind of just got to wait and see on Wednesday. So I'll update more on Wednesday when those data prints come out. But it's kind of a bit of a rundown for the week, what I'm personally expecting over the course of this week. I won't make too many assumptions on the Bank of England, as I said, till Wednesday. But Fed, I'd have to back a more hawkish move on off the back of the Fed on Wednesday, obviously for the reasons that I have outlined. The Bank of Japan is a bit more of a tricky one. Again, do they go and say they're going to continue to hike interest rates? I mean, the whole point of them, they're trying to get out of deflation, right? They've had deflation in Japan for a long time. If I go to the prices and I go to, inflation rate year over year and just look at where inflation has been for a long time, right? Let me go 10 years. Obviously, it rose over 21 and 22, but only managed to get to a peak of 4.3, and then it started to trend back lower again since that. So, not exactly fantastic for them, but kind of if I go back even to max, like if you look at where inflation has been in Japan, certainly from the early 2000s, negative inflation the whole way through the early 2000s, you then get to mid 2000s where it's kind of just bouncing around zero. You then get a little bit of a spike higher just in the lead up to the global financial crisis, right? And then a push back lower post that, and then it's just chopped zero again the whole way. Bit of a spike higher in 2013, and then a push lower, and then again it just kind of oscillates around zero up until COVID, and then post COVID it's rallied. So since the kind of early 2000s or late 90s, really late 90s, mid to late 90s, they haven't really had any inflation in Japan. So I'd anticipate inflation is not a bad thing for them, right? Again, it's coming back down, but what they want is wage hikes. They have seen wage hikes. A number of unions have come out and said the companies have agreed to wage hikes. Toyota have come out and done their first or the biggest wage hike in 25 years. More people have more money, more people can spend money. That is a contributing factor to inflation. That's what they've got over the last couple of weeks. So it kind of opens the door for them to go zero interest rates. But again, I'm not sure they really have much scope to go past that. So do you get more dovish reaction past that? If they go and sit there and say we're going to continue to hike, that puts pressure on businesses. It's kind of what they want to try and avoid, right? So again, they won't be losing money from all the debt, won't be making any, but it's a bit not making any is a bit better than losing. So, but I mean, I kind of chasing my tail a bit in terms of the analysis into this, but yeah, they won't want to cripple the economy continuing to hike and hike and hike past that. I would suggest if I was I am a betting man, so if I was going to bet on something right now for the Bank of Japan, I'd probably say the initial release might be a bit tricky because they are probably likely to end negative interest rates and end yield curve control. But after that, I can't imagine they come out and say we're going to hike multiple times the rest of the year. They'll probably want to see how it pans out for a while. That then is the situation where the Japanese yen probably weakens a bit, which is maybe a bit difficult to wrap your head around when they exit negative interest rates and exit yield curve control for the first time in a decade. Apart from that, economic data from China this morning, pretty positive. Again, that's a contributing factor to your Aussie and your Kiwi being higher. Industrial production beating consensus, retail sales beating consensus, fixed asset investment, which is a kind of real estate figure, which is super important for China. That is then above consensus, and also you can see actual 4.2%. The unemployment rate rose slightly, but that's not the big driver of the Chinese economy. inflation figures, final inflation figures out, Eurozone bang in line with consensus. Not much to see there, not much to see for the rest of the day ahead. Right, Monday, relatively quiet day. You've also then got inflation to work in with Canada, but we'll have a look at that tomorrow once we get around to it. But Bank of Japan and RBA in the overnight session tonight, tomorrow morning, and on Wednesday, inflation out of the UK. Fed 6 o'clock on Wednesday. Into then Thursday, you do have the S&B, as you can see, at 8:30. You then have the Bank of England then at 12 o'clock, and that brings us into Friday. We've got retail sales out of the UK. So big week of economic data, a lot to take in. Maybe all of what I said doesn't make complete sense, but we'll talk about it more and more as we go through this week. We'll update further when these releases come out. But that's my kind of thoughts for the week ahead. Right, we'll have to see how it pans out. I might be right, I might be wrong. If I am right, gold shorts, surely a good trade, but I've talked about that a couple of times last week. And yeah, that's kind of what I think in the lead up to this week. But we'll see how that pans out over the course of this week. We'll update further as we get around to it throughout the duration of the week. But yeah, that's it from me then, folks. Have a good day, and I will speak to you all again tomorrow.